Crowdfunding has been around for a little over 10 years. Some of the largest platforms were founded in 2012. A substantial amount of money was invested in 2015. So maybe it's a little early to ask if investors are making money, but it's still a good question to ask. Very few articles have been written about profits or levels of return on investment made by crowdfunding investors. It's really hard to find any data at all. Currently, some of the crowdfunding sites are projecting attractive returns, but the projections are based on estimated values of unrealized capital gains, so they're a bit suspect. We are in a cycle when it's difficult for startups to exit by either IPO or acquisition, so those returns may be depressed by the time they actually happen. Why should we care if crowdfunders are making money? Presumably, this is the existential question facing the industry. If crowdfunders make attractive returns, the industry should grow as a capital source for startups. Otherwise, we have to ask why we need it. I've been a bit of a skeptic about crowdfunding from the beginning. My experience as a venture capital fund manager suggested that making money on startups is difficult. My venture capital fund, 3i Ventures, returned approximately 25% internal rate of return, which is roughly what venture capital investors expect to make. Presumably, this is slightly higher than the return you could make in the stock market or real estate, and it rewards investors for the added risk they take investing in startup companies. The 25% internal rate of return may represent some kind of overall average, but the variations from year to year have been extreme. There have been years when the venture capital industry has made very low, if not negative, returns, and there have been years when returns have exceeded 25%. There have been periods of time when VCs could not take companies public, and during those cycles, many of the smaller venture capital funds have gone out of business. My concern about crowdfunding focuses on the following. So number one, crowdfunders do not have the tools to do the same level of due diligence as venture capitalists. Two, crowdfunders do not have the resources to do the background checking that the VCs do on management teams. Three, crowdfunders do not have the tools to calculate or negotiate appropriate valuations, and they may be overpaying compared to valuations a VC would receive. Four, crowdfunders may not be able to cherry pick the best deals as the VCs do, in part because their reputations for added value to companies. Five, crowdfunders are not able to interact with their companies and provide expert guidance to help make companies successful like the VCs do. And finally, crowdfunders are not able to assist their portfolio companies in going public or getting profitable exits by acquisition. If each of these issues dings crowdfunders' returns by 2 or 3%, the result could be overall returns in the neighborhood of 7 to 15% at best. Profits at this level would not reward investors for the risk they are taking with startup companies. Moreover, returns at this level are achievable with much less risky vehicles such as stock market index funds and exchange traded funds and private equity investments. So to me, the jury is still out. If some of the platforms actually achieve the investment returns they're projecting, they'll be successful and they will attract additional crowdfunding investors. But if my concerns are legitimate, the crowdfunding universe may have difficulty expanding.